If you live in Australia, you should know the ATO has stepped up their game in data matching and compliance activity for crypto. The ATO isn't guessing anymore, they know. So exchanges, banks, even overseas platforms are feeding them data. With cryptos are in the money in recent cycles, many investors are realizing gains. 1 in 3 adults in Australia own crypto assets. And if you are one of them, you need to know these 3 things. The first one is which taxes apply. Second, how much you might need to pay. And the last one is how to legally pay no more tax than you need to. I will cover these 3 questions in this video. And this is just general information, not a tax advice. Crypto taxation is complex and evolving, so please speak to your accountant about your individual scenario. Let's start with what counts as crypto assets. We are not just talking Bitcoin. The ATO includes cryptocurrencies, stablecoins, NFTs, DeFi tokens, wrapped assets, the whole lot. And what really matters is how you use it. Are you investing? Are you trading? Are you earning income? That's what drives the tax outcome. The big split here is CGT regime versus ordinary income tax. Australia doesn't have a separate crypto tax law. Instead, normal taxation rules apply. So for most everyday investor, it's capital gain tax. That bites. The ATO will tax you on revenue account if you are a trader or carrying on a business of trading. For most individuals who buy and hold crypto as investment, CGT generally applies when you dispose of a crypto asset. The CGT event A1 happens when there is a change of beneficial ownership. So basically, that is triggered when you sell it to someone else, swap a coin for another, spend it, or give to crypto. Selling for AUDs is obvious, but swapping ETH for SOL, buying NFT, or even shouting your mate around with Bitcoin, all of that is disposal. Here's where people get caught. There is no general spouse exemption in Australia. If you give your crypto to your partner, it's still a disposal, and the ATO will apply market value substitution rule to tax you on it, even though you receive nothing. And the only carve-out is during a marriage or relationship breakdown, there is a rollover which you can use to defer the CGT. On the flip side, moving coins between your own wallets, where you remain the beneficial owner, is not a disposal. Ordinary income tax kicks in when crypto is part of your job or activity. If you receive tokens as salary or as part of your services, their AUD market value when you receive them is ordinary income to you. If you are staking, validating, mining, farming, or getting airdrops, those rewards are also income when you have control over them. Their AUD market value when you receive them is the ordinary income that you need to include in your tax return. If you are running a genuine trading or mining business, profits are ordinary income. No CGT discount on this income. But the good side is expenses that you incur to buy these tokens are deductible as you are in the trading stock territory. However, for general investors, you will be in capital gain territory. So we will mostly discuss this today. You pay CGT when you dispose of a crypto asset. The net capital gain is added to your taxable income. So there are 4 scenarios that consider disposal for CGT. So the first common one is when you sell your crypto for cash. Second, if you swap one token for another. Third one, if you use the crypto asset for goods and services. And the last one is if you gift your crypto and any of situation apply, you will need to calculate your gain or loss on disposal. The same as any other CGT assets like real properties. If you held the asset for at least 12 months, individuals and trusts can generally access the 50% CGT discount. capital losses can only offset capital gains, not other income. It can be carried forward into the future if you haven't used it. Now let's do a quick example together. Say Shane buys 50,000 ADA at $2 each, a total $100,000. He later sells 5,000 ADA at $3 each, receiving 15,000. The exchange charges a 0.2% fee, which equals to 10 ADA taken from his wallet. So the main sales CGT calculation is started with the proceeds equal $15,000 that he received, and the cost base is $10,000, which is 5,000 tokens at $2 each, plus the exchange fee of $10. His capital gain is $4,990. After the 50% CGT discount, his net capital gain is $2,495. Here, if he had multiple parcels that he bought at different prices and his record allows, he can use specific identification to choose the parcel with the best cost base or just the first in, first out, whichever is reasonable and backed by records. DeFi and wrapping. Here's where things get messy. The ATO has flagged that many DeFi steps, swapping, wrapping, unwrapping, depositing, where beneficial ownership changes, they are disposal for CGT. So don't assume wrapping is a tax neutral position. Make sure you keep clear evidence. If you believe a step doesn't trigger CGT, you can actually defend yourself if your record is good. The ATO's default position is new token, new disposal. Now, let's talk about how to legally reduce your tax bill. The first common one is the 50% CGT discount for someone held the asset for more than 12 months. And this only applies on capital account, which means when you are an investor. Second is you can claim all incidental costs in your cost base, exchange fees, gas used to execute the disposal, brokerage fee, and relevant professional costs. Third one is use your capital loss properly. You can crystallize genuine losses to offset gains, but beware of wash sales behavior. If the main reason you are selling and rebuying quickly is just to score a deduction, the ATO can cancel it under the anti-avoidance rules. And the next one is personal use asset exemption. The ATO has explained that this is rare with crypto. If the crypto was acquired to purchase personal items and actually used within a short period of time, or the cost is $10,000 or less, a capital gain may be disregarded. But same as the gain, your capital loss on crypto under personal use asset are also ignored for tax. If you are holding mainly as investment or to profit, the exemption won't apply even if you eventually spend it. The last one, if you are earning staking or mining income, you can claim reasonable expenses like electricity, hardware, exchange fees, and software fees. And the most important message of today is records. The ATO already gets exchange data, but I expect your records to reconcile dates, AUD values, what each transaction was for, wallet addresses, and receipts. If you don't have records, they will make assumptions. And trust me, their version of the story won't be the one that you like. And if you've made some mistakes in the past, don't worry and don't bury your head in the sand. Amend your return or make a voluntary disclosure. Coming forward early usually means reduce penalties and reduce interest. And it will be much easier to ask for remission on this amount as well. If you wait for the ATO to send a letter, that's when the penalty is piling up and they normally reject the remission request. So don't be the investor who says the ATO will never know. They already do. Stay informed, keep good records, and don't pay any more tax than you need to. If you find this video is helpful, don't forget to like and subscribe. I'm Hannah, the tax advisor you can trust. Thank you for watching and see you next time.